Hey guys, it's Nick, and in this video, I want to show you how to buy individual corporate bonds on Charles Schwab. Let's get into it. So to buy some bonds, go to Trade, click on that, and select over here, Bonds, click on that. So you get this overview screen here of different bonds with different maturities as well as CDs, so you can compare the rates. So what you should do is compare the rates to what U.S. Treasuries are paying, because U.S. Treasuries are considered a risk-free asset. So any corporate bond is considered more risky than a Treasury. I'm not sure why they don't have any 3-month or 9-month corporate AAAs listed here, but just look at a 6-month AAA is paying 3.83%, while a Treasury bill is paying 5%. Now, this is more riskier than this, so it's a no-brainer to buy the Treasury bill over a AAA corporate. Now, that changes as you go farther out along maturities here. Say like a 10-year pays 4.81 versus 3.84, and a 30-year pays 5 versus about 4. But again, we are in an inverted yield curve, so the shorter term maturities pay more than the longer term maturities, which is an anomaly because it is way less risky to lend out for short term than it is for long term. So this is going to correct itself eventually after we get into a recession. But for now, we have to deal with this inverted yield curve. And so even if you want to be in bonds for a long period of time, if you believe that interest rates have not peaked and that they will continue to go higher, that the Fed will raise interest rates, then you want to stay in the shortest term treasuries and just keep rolling it over when they mature until the point where you think interest rates have peaked. And then you would go to the longer term treasury bonds to lock in that interest rate. But if you think interest rates have peaked, then you would already be looking to buy longer term bonds. So I'm not saying interest rates are going higher or that interest rates have peaked. You have to make your own determinations about that. But that is what you would do based on your opinions of where interest rates are heading in the future. And so right now, short-term corporates don't make any sense, because even the A-rated, which is lower rated than the AA and AAA, are still paying less than treasuries up to about 1 year. After that, then they start paying more than treasuries, but it's a lot more risk, right? And when you go out to 30 years, it's a difference of about 2 percentage points. But with the higher percentage interest comes higher risk. So let's see what kind of bonds you get when you're getting 5.92% interest. Click on this. So companies like Intel, Alibaba, Facebook, Duke, Qualcomm, they're not bad companies, but they have more risk that they will be around in 30 years. So that's why they pay more. Let's go back. Now look at just AAA corporates. Click on that. So this is interesting. I didn't even know universities issue bonds. MIT, Ford Foundation, Microsoft, Rice University, Johnson & Johnson. So those are companies that are more likely to be around in 30 years, so they pay 5%, which is only 1 percentage point above treasuries right now. Okay, so let's start with buying a new issue bond. So let's click on new issues. So they have municipal bonds, treasury auctions, and retail notes. I don't know why they don't call it retail bonds or corporate bonds, but let's select that. And so there's a lot of things you can filter on by the face value, the minimum face value. I'm going to leave that alone. Yield to maturity, maturity date, coupon frequency, minimum rating, and all that stuff. Let's just leave everything alone. Callable or non-callable. You probably want to get non-callable, but again, we're just going to look at some short-term bonds, so it's not really going to make a difference. Click on View Search Results. So there's not a lot of bonds offered here, and it looks like the minimum is $25,000 to buy any of these bonds. But anyway, let's pretend we're going to buy this Goldman Sachs BBB plus S&P rating and A2 Moody's rating. And it matures February 28th, 2025, so 2 years from now. and has a coupon of 5.25%. The price is the par value, meaning this is how much you're going to receive when the bond matures, and this is how much you're going to pay on this new issue. Now, this price can change once it starts trading and interest rates go higher or lower. So if interest rates go higher after this bond is issued, this par value will go down a little bit. If interest rates go lower, this par value will go up. Now it says this bond is callable, but the yield to maturity and the yield to worst are the same. So the yield to worst means the yield you will get even if this bond is called. So you will still get 5.25% even if this bond is called away. But just looking at this yield and these other yields, in my opinion, it makes no sense to buy any of these because going 2 years out, you can get treasuries for about 5%. This is a little bit higher, but it's definitely more riskier than treasuries. So in my mind, a little bit of difference in interest by buying something risky versus a risk-free like a treasury at this point doesn't make a lot of sense. That may change in the future, but right now, I would not buy this over buying a 5 or even 4.9% treasury going 2 years if I wanted a 2-year bond right now. So you see quantity 25, that's the minimum quantity. That's why it's saying estimated cost 25,000. So that's another reason why these types of bonds are not really for small players because they have minimums of like $25,000, where you can buy treasuries with a minimum of $1,000 on something like Schwab or Fidelity or Vanguard. And if you buy them on Treasury Direct, I believe the minimum is $100. So let's take a look at the details of this bond. Coupon rate fixed semi-annually, dated date. This is when it starts accruing its interest. 2/28/23. Call details. Callable quarterly beginning 8/28/23. So in 6 months, they can start calling this bond back. Every quarter, they can call some back or all of it back if they want to. Okay, so let's buy this. Okay, everything looks good. Maturity 2 years, 11 days from now, right? $25,000 minimum. So you cannot put 1,000 and try to buy this. So 25 limit or market order. So it doesn't matter because the price is $100. So whether you say market order or limit order, you're still going to get that $100 per bond face value, par value price. Fill or kill just means either fill my whole order of 25 bonds or cancel the order completely. Now, because this is a $25,000 minimum, they're not going to cancel it because that's the requirement for this. Okay, review order. So here's your order, $100 limit, fill or kill, settlement date 2/28, total cost 25,000. Now here's one of the things that I don't like about Schwab. You see, I don't have free cash to cover it because my money is in a money market in Schwab. And to free up that money, you cannot just go and buy something. You have to sell that money market and then let it settle for a day, and then you can use that cash. Whereas Fidelity doesn't have that. You can keep your money in a money market, but it's like cash. No matter how much you put in or take out or whatever, it goes into the money market automatically. You don't need to sell the money market, free up that cash. Just something to consider. Okay, and then you would just place the order. So I'm not going to do that, but one other thing is pricing, right? Individual bonds new issue is 0. Bonds in the secondary market is $1 per bond, but a $10 minimum and $250 maximum online. But if you call a broker, it's $25 plus online fee plus $25, so $35 minimum. Now, treasuries, new issues, and secondary cost 0. So that's another reason to buy treasuries over corporate bonds if they're yielding about the same interest. CDs as well, it costs 0, and they only have $1,000 minimum requirements. And so they even have secondary market CDs, which I don't know, I wouldn't bother with those. Bond funds, zero transaction fee, no loads. So let's see how to buy a corporate bond in the secondary market now. Let's go back to this screen and click on Find Bonds and Fixed Income. And you can filter the bonds you want to see. So let's take a look. I want to see both buy and sell prices. Face value, 1,000, filter by face. All right, so you could choose any different kind of bond. We're keeping it corporates. You can also filter by sector or industry. So maturity date, I'm going to go out, say, 2 years. So February 23 to February 25. Minimum coupon, I don't care. Coupon frequency, I don't really care either. And I'm not going to sort by the credit rating because I want to see all of them and see what the different rates are based on how bad the ratings are. Include only, zero coupon. I don't really care about that. Up to rate coupon, non-callable is what I want to see. And so let's just search here. So let's take a look at what we have here. Citigroup 3.5% coupon, matures May 2023, rated triple B by S&P. And I want you to notice the ask and the bid prices here. So the ask price, meaning if you want to buy it, it'll cost you $100.63. But if you want to sell it, you could only sell it at 98.67. And so that huge spread, it's probably because this doesn't trade a lot. So the difference between the yield to maturity, if you were able to buy this on the bid, which I don't think you are, is 9.374 if you bought it on the bid. But if you bought it on the offer, your yield to maturity is only 0.69%. So you really got to be careful when you buy corporate bonds because some of these don't trade a lot and they have huge bid-ask spreads. But let's sort by yield to maturity to see what's the highest yielding in the next 2 years. Okay, so you got Dominion Energy, which I'm a little familiar with this company. I've bought it before, and I know right now if you buy the stock, the dividend is about 5%. But this thing is yielding to maturity 4.721 if you buy on the offer. If you were to buy it on the bid, you would be yielding 6.3%. So like I said, that there's not much reason right now to buy shorter term corporate bonds when T-bills are paying more than these very badly rated bonds, right? Triple B, Wells Fargo, Citigroup, and let's see the market depth. So this is the order book, and it shows all the orders that want to buy and all the orders that are offering to sell at different prices and different amounts of bonds. And it shows the corresponding yield to maturity at these prices. So if you were to buy this bond, you'd be buying at this price with a yield of about 5.38. But if you were to sell this bond, you'd be selling at 96.32, which is a corresponding yield of 5.69. Now, this is how many bonds are for sale, but these are the minimum quantities. And so if you want to buy bonds and you don't want to buy less than 15, you're not going to get this price. If you want to buy, say, 10, right, here's the minimum 10, you can get this price, 96.758. But if you just want to buy one or two or whatever, you're going to have to pay a higher price, 96.768. Okay, so let's say we wanted to buy this, click on buy. Let's just make sure everything's correct. 1 year, 5 months, and 25 days from today. Coupon rate is this, but you're actually going to yield this, 4.723 at this price. So put in the quantity here, right? This is in thousands. So if you want to buy $1,000 worth, just put 1, do not put 1,000. Order type, you can put market order or limit order. Never use market order. Always put the limit order, because on a thinly traded bond like this, if all of a sudden a few of the offers get removed, then you might find yourself buying this bond at a lot higher price. So stick with a limit price. And so the timing is fill or kill. Now for one bond, this doesn't make a difference. Review, continue. And just notice that the markup is $10 because that is the minimum price for secondary market bonds for Schwab. It is $1 a bond, but it's a minimum of $10. So whether you buy one bond or 8 bonds or 10 bonds, it's still the same $10. So notice that the price is less than 100, right? The par value for this bond is 100. So because it only yields about 3% in a market that's like 5%, it has to be discounted, right, to make up for that. So the discount that you get under par value, right, you're going to get $1,000 back for this bond, but you're only paying $977. Plus, you're going to get whatever coupons it has until it matures. So that's probably 3 coupons from now until August 2024. So the total return you'll get is about 7% or 1.5 times this number, 4.723. So all you have to do, everything looks good, just click the button and place the order, and that's it. But again, why go through all of this to buy a worse rated bond than Treasury bills, which are risk-free, and they're yielding more than 4.723. So at this point, in my mind, it's a no-brainer to not buy corporate bonds and just buy treasuries if you're only going out like a year and a half or less. And so you see here, treasuries, 3 months are 4.83, and going out 18 months, like that bond that we just looked at, is 5.03%. So AAA corporate bonds don't start paying more than treasuries until you go out to about 3 years, right? 4.62 versus 4.45. So if you want to buy any bonds less than about 3 years, it's a no-brainer to buy treasuries versus corporate AAAs or anything worse rated than AAAs. I hope you like this one. I'll see you in the next one. Thanks for watching, guys.